Should I just blame it on holiday illiquidity for what we're seeing in the markets right now, or is there something else?
Wow, there is so much going on right now that we didn't see before. December's the traditional season when strategists write their outlook for the following year in the early part of December and then hope to take the latter part of December off. But I think probably there'll have to be some rewriting this year about what might occur in the next year.
How are you rewriting it, the narrative right now? Do I look past these headlines on Omicron and just focus on the fundamentals for 2022? How are you viewing it?
Well, no, you can't look past the headlines. I can't predict Omicron any better than anyone else, but it certainly was an unknown even a couple of weeks ago. And the news that you just shared a few minutes ago about it being the predominant variant in the United States and other places indicates that there's a good chance that it'll slow things down over the course of the next few months. We don't anticipate a big shutdown as we've seen in the past, but there's no doubt that it's going to slow down economic activity at the very same time that to what stimulus there might have been, at least in the United States, from the Build Back America plan will not be happening. And so we're seeing a potential slowdown on the growth side. If we look at the inflation side, we have had a very odd inflation in which that inflation, where supply has been hit more than demand. We've had demand, and because of Omicron, and also because the demand has been for goods rather than services, we haven't been able to keep the supply up. And so the perverse thing that might happen is that we could still have that type of inflation.
Okay, so is that something that is somewhat concrete for next year, that you can kind of put a strategy on that? How do you position around more higher inflationary pressures next year?
Well, I still think I wouldn't make the, we still think that inflation can settle down and the supply chains can sort themselves out. I think what we have is a period of unknown. And when you move into an unknown, the market moves into a risk-off type of trade. And our overall view is still to be a little bit in the risk-on trade. I think that we're in a very good situation, particularly for many companies, because they have this situation of inflation in which they can pass on prices, but not the downside of inflation, in which interest rates are likely to be very much higher. I think the Federal Reserve's last statements were actually fairly open statements. But I think that with all of these changes, it could be the situation that the reserve banks don't act very aggressively. But even if they were, they're still below neutral.
So if they can't be as aggressive as what they're saying, according to the dots, then should I assume that bond yields, in particular treasuries, are continue to edge higher, or is that something that still we're not going to get that kind of scenario next year?
I think that, again, we're in the certainty that we have going into this next year is that we need to be humble about making predictions going forward. But I think there's a likelihood that interest rates or changes in interest rates are already priced in, and it's likely that interest rates won't march a lot higher or above expectations as we roll into this next year.
Biggest conviction trades then for 2022, Stephen? I mean, given just the uncertainty that you've highlighted, you got to be nimble. Can you actually buy this dip right now?
I think this dip is perhaps an opportunity to buy. If you're out of the market, we're positive on the market. There aren't a whole lot of opportunities to equities. We're going to get through this Omicron situation and markets will open it up again. So if you can look at stocks that have pricing power and are going to do well as the market opens, I think those are opportunities. There could be opportunities in the energy sector, both in terms of alternative energy, but also traditional energy. As the markets open, we see opportunity there as well. We see opportunity within fixed income in the corporate space, particularly corporates that are likely to be upgraded because the economies will continue to be pretty healthy. Broader, I think there's opportunities in real estate, particularly private real estate. And within that, you might even look at such things as industrial real estate, where I think there'll continue to be opportunities.
Okay, since it's a China show, I got to ask your take on what's been going on in the ADRs over there and other tanking that we saw on the Nasdaq Golden Dragon, this time on the back of more crackdown concerns, this time in live streaming. And you also on the back of that have to deal with the delisting concerns as well. How are you viewing Chinese tech at the moment?
Well, our emerging markets team is still positive over the long run of the remarkable changes that have happened in emerging markets through technology, and that emerging market indices are much more technology based than they were in the past, being much more commodity based. So we have to be very cautious about what's going on in China, but we still see opportunity there. We think technology is what's likely going to lead the emerging markets over the next few years. And so again, that's probably an area where we see some opportunity. In the more economically sensitive parts of emerging markets, we have some concerns if emerging markets with the Omicron have weakness that they wouldn't have anticipated otherwise.